Welcome to our latest podcast. My name is Elizaveta Gridneva. Joining today to discuss precious metals, Erik Norland, who is a group economist for SME Group in Europe. How are you, Erik?
I'm doing fine. How are you?
I'm good. Gosh, how things are changing rapidly. We can't know what tomorrow will bring. Maybe the headlines can shift at any moment, but let's deep dive. And I would like to pick up your thoughts today on precious metals. Erik, one of your recent articles, you opened by pointing out something that feels counterintuitive. Geopolitical conflict that raises inflation risks, yet falling prices for gold and other precious metals. What's the key mechanism that explains why the classic safe haven hasn't played out this time? Or simply put, why haven't precious metals behaved like traditional safe haven?
So, precious metals, what they do in the economy is very interesting. They tend to anticipate inflation before it happens. So, to give you an example, precious metals prices soared in 2019 and during the first half of 2020. But then, when inflation actually struck after the pandemic, what happened was that central banks raised rates a great deal, which made holding currencies like the US dollar and the euro, etc., more attractive than it would have been otherwise, and therefore depressed precious metals prices. So precious metals prices started this massive rally again in 2025, and gold even earlier than that, but silver, platinum, and palladium in 2025. It kind of peaked out in January 2026. And then as the war began, precious metals prices initially fell a little bit further. And the reason for that is that we are seeing more and more central banks beginning to raise interest rates. So even before the war started, for example, the Reserve Bank of Australia started raising interest rates. After the war started, we started seeing the Bank of England and other central banks, even the ECB, start considering the possibility of rate hikes. Meanwhile, in the United States, where the markets still price that the Federal Reserve is likely to cut, they price fewer cuts than they had before. And so precious metals sort of anticipate inflation in advance. But then when inflation actually strikes, it's not always good news because it can mean higher interest rates, which means it's more attractive to hold government issued currency.
Understand. And if we talk about inflation expectations versus realized inflation, you described the rally in precious metals through early 2026, as you mentioned, as being driven largely by fear of inflation rather than inflation itself. Could you explain this by the rumor sell the fact dynamic and why realized inflation can actually become a headwind for precious metals in the short term?
Yeah, so precious metals are basically in competition with currency. They're essentially a form of currency in a way, but they also have, of course, some industrial applications, especially for silver, platinum, and palladium, a little bit less so for gold. But they can all be seen in a way as a currency. But the thing is, these are currencies that pay zero interest. And so when central banks are lowering their interest rates, it makes holding precious metals relatively more attractive. But then when investors shift their psychology and stop expecting rate cuts and begin to expect rate increases, that's usually bearish for precious metals because some portion of those investors might decide, okay, well, gold, silver, platinum, and palladium are now quite expensive. And now the interest rate on currencies is about to go higher. So maybe I'll just keep my money in cash.
And also, I would like to get more insights on central bank credibility and rate expectations topic. If I quote your article, you saying that a major turning point you highlight is the market's reassessment of central bank independence, particularly around the Fed, and how that shifted expectations for future policy. What do changing rate expectations matter more for precious metals than inflation headlines themselves?
Yeah, so for many decades, central banks were seen as being credible in the sense that they were keeping interest rates high in order to fight inflation. So during the 1980s and 1990s, for example, we had high interest rates and the price of gold came down very significantly. It dropped from 800 down to around $280 an ounce. But then starting with the 2001 recession and especially the global financial crisis, we entered into a period of much lower interest rates and expanding Fed balance sheets and expanding balance sheets at the ECB, the Bank of Japan, Bank of England, et cetera. And all of that tended to be very bullish for precious metals. And then particularly during and after the pandemic, central banks created gigantic amounts of liquidity in order to fund budget deficits. So I think that there's been this growing fear that central banks are gradually losing their independence. They're losing their interest in fighting inflation. Even after the pandemic subsided and inflation rates came back down, they remained above central bank targets. Most central banks target 2% inflation. In the last few years, we've been running inflation closer to 3%. And despite that, central banks were cutting interest rates anyway. So there was this real concern that we might have somebody appointed to lead the Federal Reserve who was not going to be independent, who was going to bow to political authorities. But it doesn't seem like that's the case. Kevin Warsh had taken a very independent line when he was on the Federal Reserve Board previously. He was an opponent of quantitative easing when he advocated for a tighter monetary policy. So when his appointment was announced, it kind of turned the tide against precious metals, at least in the short term. What happens longer term remains to be seen.
Great. Thank you for this. This is very insightful to understand more what's happening inside. Let's now talk about the role of US dollar during geopolitical stress. So you emphasized that dollar's role as a flight to quality asset after the conflict began. How important has dollar strength been in pressuring precious metals, and how does that interact with the broader risk off move we have seen across portfolios?
Yeah, so during the first few weeks of the conflict, the dollar rose versus most other currencies. And all of the precious metals have a negative correlation to, say, the Bloomberg Dollar Index, which is the broadest and most comprehensive measure of the US dollar. Yeah, so as the Bloomberg Dollar Index rose in the first few weeks of the war, precious metals prices all fell back. Now, in the last few weeks, that's reversed again. The dollar started to weaken against not all the currencies, but against some of the currencies, and precious metals are starting to show new life.
Understood. And looking ahead, you argue that many of the long term supports for precious metals, like persistent budget deficits and above target core inflation, are still intact. What signals would you watch for that might indicate the market is starting to price renewed policy easing and a more durable rebound in precious metals? So, what would actually change the outlook?
Different things could change the outlook in terms of making either a more bullish or more bearish case for precious metals. So, one of the big tests right now is that a lot of the short term interest rate markets price higher interest rates in Australia, the United Kingdom, the Eurozone. Now, the question is, do the central banks actually follow through? Do they really raise interest rates into an oil crisis, into tight oil supplies, and perhaps slower economic growth? If they don't raise interest rates as the markets price, that could be bullish for gold. Likewise, there's a question of the Federal Reserve. Do they cut interest rates more than what the forward curve suggests? We don't know what they're going to do, but if they do, that would probably be bullish for gold. When it comes to fiscal policy, I don't really see many changes coming at the moment. It looks to me like basically every major country is either keeping their budget deficit where it is or they're going to expand it further. So the fiscal case for owning precious metals is still very strong.
Thank you, Erik. That's truly exciting journey, and I really appreciate you bringing your expertise and deep knowledge on precious metals to our listeners today.
Well, thank you for having me on.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Investments in certain commodities, precious metals, may be subject to significant price volatility and often involve risks related to market fluctuations, liquidity constraints, geopolitical events, and changes in global economic conditions that could adversely affect their value. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. U.S. spot gold trading through IB LLC accounts is only available to legal residents of the United States that do not reside in Arizona, Montana, New Hampshire, and Rhode Island.